I'm Nicole Lappin, the only financial expert you don't need a dictionary to understand. It's time for some money rehab. Is 2008 repeating itself? That is the question I keep seeing in the headlines, and today I'm talking to the perfect person to answer that question. Steve Eisman doesn't need much of an introduction. He is the investor who famously saw what no one else saw in 2008 and bet against the market before the crash. He was immortalized in the movie The Big Short. He was portrayed by Steve Carell in that movie, so kind of a big deal. Now he's talking about what he's seeing in the current market on his podcast, The Eisman Playbook, and today right here on Money Rehab. So I asked him the big question, is this history repeating itself? And he answers that and a lot more. He tells me whether he thinks we're on track for a recession, where he sees opportunities in this market, what he thinks Trump is going to do next, and his advice for new investors. Steve Eisman, welcome to Money Rehab.
Well, glad to be here.
Damn, it's been a week. How are you doing?
Really? Did something happen this week?
Yeah, no, I haven't looked at the news lately. Who do you think needs a hug right now?
Who needs a hug? I think a lot of people need a hug. I don't know about you, but I think everybody's pretty emotionally exhausted from this week.
Yeah, I need a hug. I mean, for those who haven't listened to Steve's podcast yet, the Eisman Playbook, please run, don't walk, and listen. You and your team talk about the story of '08, where you guys met with the CEO of WAMU, who knew you were short their stock. And as soon as you walked in, you said, "You look like you need a hug."
He did, badly. And I hugged him.
A lot of people need a hug these days.
It goes a long way.
I want to do some time travel back to '08, but I want to start with where we are right now.
Sure.
We're talking on Thursday, April 10th, and I preface this because every day is some big move or something.
Every day? How about every hour?
Every hour. You need Valium or a drink, or I don't know, maybe both.
Or not look.
That too. So is that what you suggest? I mean, this week the market dropped 10% on Trump's tariffs, rallied 9%. We are back down 5%, I think, at the time we're talking. Mm-hmm. Is this a relief rally that we're going to settle into, or is this more of a bear market? What is going on?
I don't know if it's a bear market yet. In normal times, markets have many variables. PE, earnings. Maybe there's some news about OPEC. It's multifaceted. And every now and then, '08, COVID, now, it all gets boiled down to one thing. And the one thing right now is what's going to happen with trade. And, people are trading headlines because they're petrified there'll be a trade war and therefore a recession. And then when they have news that says maybe there won't be a trade war, they get euphoric. It's going to be like this for a while.
So big swings.
Volatility is here. I wish I could say make volatility your friend, because I personally don't really know how to do that. Some people do. It's here. You're just going to have to tolerate it for a while.
Well, the VIX, the sort of fear index, has been up for a while. P's have been high. Multiples have been high. There's been a lot of warning signs flashing across the market for a while now, even before all the tweets on tariffs and announcements on tariffs. Do you think even if we didn't have all this tariff drama, we were bound for a correction anyway?
No, I don't think we were bound for a correction at all. I'm actually, generally speaking, pretty positive on the U.S. economy. I think the U.S. economy is more dynamic than it's been certainly in my lifetime. And so the long term is very good. But this is certainly a wrinkle.
I mean, historically, we've had a correction every couple of years anyway. So
of course,
10%.
Every now and then you get somebody at some interview who says, generally it's like Tommy Lee. He'll say something like, on a day when the market goes down, like, well, it's a correction. It's healthy. And my response to that is, I don't need to be so healthy.
I mean, do you think that the market was sick?
No,
before all of this?
I don't think it was sick before this at all.
So you have said that you thought if tariffs continued, we'd be in a global recession. They have paused for 90 days now. Do you still think that?
I think there's a lot more going on here than just, tariffs, trade war. And I think to understand that, you need to go back to the 90s. President Clinton. We had President Clinton. And President Clinton ushered in NAFTA, and he brought in China into the world trading system. And he did so, he made two arguments. His argument number one was that improving global trade along those lines would accelerate GDP growth and it would create jobs. And he was 100% right on the former, and he was 1,000% wrong on the latter. You know, if you, after the Big Short movie, I got this really great speaking gig. I traveled all over the country, different universities, places, conferences. You know, I saw parts of the country I really had never seen before. You know, if you go to a university town, generally you fly into some airport and you have to drive for an hour and a half, and you go through the towns of America. And what you see in the South, the Midwest, is not only did people lose their jobs, they lost their communities. So I think what President Trump is arguing, and you can disagree or agree, I have great sympathy for it, is that we really screwed half the country because of free trade. Now, it ushered in an enormous bull market with with some fits and starts. But generally, since 1994, it's been a tremendous bull market where people like me and others of my socioeconomic class have made a lot of money. But the other half of the country got obliterated. And we didn't even retrain these people. We said, you're on your own, go learn how to code. And they didn't learn how to code. So I think he's trying to achieve two things. He's trying to improve the terms of trade, and he's trying to bring back a lot of jobs to the United States. Now, how do you do that? Oh, I'll tell you how you don't do that. The way you don't do that is convene a meeting of the G7 and say, hey, guys, the United States needs to change the terms of trade because it's not fair. Will you help me out? They'll laugh at you. The only way to change the terms of trade is to put a bazooka to people's heads. And once you put a bazooka to people's heads, people start negotiating. And the other thing that I think is often missing from, conversations that you see on podcasts and television is that the United States is in the best possible position of any country to change the terms of trade. Hard stop. Because the percentage of US GDP that comes from exports is only 11%. That's about the lowest number in the world. If you look at it region by region, country by country, if you were to Google China and say, yes, Google or Perplexity or Gemini, and ask what percentage of China's GDP comes from export, you'd get 19%. And that number's not right because so much of China's exports get routed to Vietnam and Cambodia, et cetera, and then come overseas. My guess is that number is probably closer to 30%. Europe, every significant country in Europe is in excess of 30%, with the exception of Germany, which is over 40%. Mexico and Canada are both 35% of their GDP is from exports. And of that 35%, 25 of that 35 is pure exports to the United States. So my hope is simply that the US, in terms of who's in the best position to negotiate, the US is in the best possible position. So if
because the number is so low.
Because the number is so low and everybody else's number is so high, and they all need they all need access to our consumer. I mean, Mercedes-Benz. Do you think Mercedes-Benz can survive by not selling any cars in the United States? I don't think so. So if everybody's rational, and believe me, that is a big if, people will come to the United States and they'll negotiate. Now, I have a very good friend who runs a hotel in DC. And by chance, I was speaking to him this weekend. And he said, what he's hearing from all the other managers of hotels, because they all know each other, is that the hotels of DC are packed with people from countries looking to negotiate with the Trump administration as we speak. So like I said, if everybody's rational, everybody will try and cut as good a deal as they possibly can. Now, not everybody is always rational, as we know.
Is China rational?
We're going to come to that in a second. But politicians have to get reelected. They may feel like if they cut too good a deal, they'll get thrown out of office. So I can't handicap this. China, I think, is a different animal. I'm not sure what the administration's motivation here is. I think perhaps they would take it either way. If they could negotiate a good deal with China, they would. And if they have to leave the tariffs on and basically cut China off from the United States, they'll do that too. So you may have a situation where everybody but China cuts the deal. That's possible.
And in that case, are we still going to be okay? You said on CNBC
I think we will
recently,
be okay.
I mean, you were short everything in '08. You said you're long only now. How long is long? In other words,
100%
how long do you think this bear market vibe session
could
is
last
going to last?
a couple of months.
That's it?
Well, they'll negotiate. They'll either negotiate or they won't negotiate. It's not going to take, I think, more than a couple of months to be very clear of what direction this is going in.
Okay, let's talk about an underlying issue here that you've talked about before it was cool. I did an episode this week about the theory that tariffs weren't about a trade war, they were about a yield war, that a crash in the market would mean people would essentially flock to bonds and yields would drop, and that would help the government refinance the $9 trillion of debt over
Yeah,
the
it's a good
next year.
conspiracy theory.
Do you think it's a conspiracy theory or do you think that's what's going on? Because
I,
it's
I, I
interesting,
actually
yields
don't.
haven't dropped.
Yields haven't dropped.
So it's weird. What's going on?
Every now and then you get into an environment where people in the bond market start to question the reserve status of the dollar. And so you get these short-term periods where either the dollar sells off or yields go up because people are selling the bond, which is basically the same thing. And I think we're in a little bit of that right now. And that's why I think yields haven't dropped. I don't think that's a long-term problem, though.
So you think yields will go down with
Well, if
the
we have a recession, it will definitely go down.
turmoil? Do you think it's also potentially people are covering the losses from the market by selling bonds?
I mean, I don't know where hedge funds stand right now. Yesterday was so crazy. Clearly, there were a lot of people over their skis, and they were just covering like crazy. But I can't answer that question. I don't know.
So rates will go down. Sounds like
Probably.
that's
Yeah.
inevitable. We don't know when. The president thinks he controls the Fed. He does not, but he can sort of force the hand and put pressure on it. You said on your podcast that if the goal is for rates to go down, then perhaps looking at investing in assets that benefit from lower rates, like home builders or real estate, could be a move. How is that view complicated by rates not cooperating?
I think the rate story is more short term. So eventually they'll come down. The problem with making a bet on home builders, and I have a little bit of a bet myself, but the problem with making a bigger bet is that if, let's say, tomorrow, hypothetically, every country reaches a deal and the economy is fine again, rates aren't going to go down, and there goes your home builder trade. So everything is just so binary related to the macro that the only thing I would tell people, and this is what I've done myself, is you should de-risk. You should sell. Don't go crazy because if you sell everything, you're paying taxes. But if there's something in your portfolio that you've kept but you're not that crazy about, sell it. If you think you can afford to pay taxes and lighten up so you'll have some cash so you could sleep at night, do that. But I wouldn't do anything draconian.
Sell it at a loss? Sell it at a gain? You say pay taxes.
If you could afford to pay the taxes, you should sell some and just pay the taxes. But I wouldn't do anything big.
Well, you said you're long for a few months, presumably when we get more clarity on tariffs. And then what happens after that? Are you short
Well, I
again?
have some cash and hopefully things get better and I'll buy some stuff.
But wouldn't you buy stuff when things are not better? When they're
Well, like I said, it's so
lower?
binary. The tariff situation could go the wrong way, and then everything you'll have bought will go down. So, this is such a binary, one-dimensional market. It's very difficult to handicap. What I'm telling people is don't be a hero.
So take a pause.
Take
I
a
mean, when
pause.
any cuckoo crazy stuff goes on, it's better to take a pause. Go through a breakup, you have a market issue. Nobody regrets a pause.
Right.
Ray Dalio warning about a sovereign debt crisis in the midst of all this. Do you buy that argument?
Not
What's the
even, not even a
probability?
little, not even a little bit. I just don't. I think the deficit is too big, de-dollarization, everybody's going to sell their treasuries. It's Armageddon, cats and dogs are going to lie down together. It's the end of the world. Story has been told on and off by people for 40 years. What I think people miss about when they talk about sovereign debt crisis stuff is that the entire global financial system runs on treasuries, period. Banks do overnight repos, which is where they lend to each other overnight. They do it in treasuries. Sovereign wealth funds park their money. They do it in treasuries. There is no alternative. And the reason why there is no alternative is there's no other asset class that is anywhere close to as liquid or as safe. So if the Chinese bond market was a much bigger and better market, or crypto was 1,000 times bigger than it is today, we could have a discussion. Until then, it's just short-term gyrations as far as I'm concerned.
So the probability you'd assign to a US debt crisis in the next 5 or 10 years is zero?
I don't know about zero. A lot of things can happen in 5 to 10 years, but right, as low as it's not something I worry about. I just don't worry about it.
So do you think Ray needs a hug?
I think he needs a hug. He does. He needs a little bit of a hug.
I mean, when we talk about this number, though, Steve, 9 trillion in treasuries is a lot to finance.
Yeah, but
right?
the economy
Does that scare you?
the economy is a lot bigger. They were saying the same thing when it was 1 trillion. It's just a number. I just don't think it's not an issue.
So that number doesn't scare you more than subprime mortgages did in '07?
No, subprime mortgages scared me to death. This does not scare me that much.
Does anything scare you right now?
Yeah, what scares me is the potential for a trade war. That scares me. And I wouldn't put that as a zero probability. President Trump is playing high stakes poker right now.
Do you think he's just going to say, psych, just kidding, this was...
No, I don't think he's going to say psych, just kidding. I mean, you could like President Trump, you could dislike President Trump. I'm not making a political pitch here, but I think one thing that is extremely admirable about him is that he's one of the few politicians I've ever seen where he actually goes out and does what he told you he was going to do. He campaigned on this. This is what everybody's shocked by. He told you he was going to do it, and he did it. And everybody's like, I can't believe he did it. I said, what do you mean? This is not like, when President Bush got elected the second time, or was the first time, I can't remember which one it was, and they immediately tried to change Social Security. And everybody said, what do you mean you're trying to change Social Security? You didn't mention this on the campaign. This was front and center throughout the campaign. So I don't understand why people are shocked. I guess they just, I think part of the issue that people have is everybody that we know took Econ 101. And in Econ 101, they all taught you that free trade is good, tariffs are bad, trade wars are terrible, and they showed it to you with graphs and tables and pictures, and it's all very, very convincing and mostly right. Except what they didn't tell you is that free trade can obliterate industries. They make it, when you took Econ 101, they made it sound like if you divide the world between guns and butter, one country should produce all guns, and the other country should produce all butter, and everybody would be better off. And what was never discussed was, yeah, but what happens to all the people who are making butter who lose their jobs? They make it sound like they're all going to get a job making guns. That's not how it works. All these people lost their jobs, and a lot of them are on welfare, and nobody ever offered them an opportunity to retrain. So it got very ugly.
Well, I'm glad that you mentioned that he did campaign on this. We knew this. This wasn't a surprise. I think the thing people are most concerned about is the extent with which he did it, right? This wasn't a scalpel. This was a hatchet.
This was a bazooka.
Bazooka.
Yeah.
People thought there would be tariffs, just not this aggressive. Is that fair?
Oh, I think it's this. Yes, I agree. But I think if you take a step back again and ask yourself, if you want to change the terms of trade, how are you going to do that? You can't be nice. You got to be mean. You got to be tough. And then, given the fact that only 11% of our GDP is from exports, let's talk.
You don't have much to lose.
Yeah, it's not that you don't have much to lose. You have something to lose. You have less to lose than everybody else.
Hold onto your wallets. Money Rehab will be right back. And now for some more Money Rehab. So we opened the door, Steve, up to a little 2008 discussion. Some reporters are out there. I'm sure you've seen them all
They're
comparing
all
this.
calling me. They're basically saying, please
Well, thanks for answering our
predict the
call.
end of the world again. And I'm like, dude, I've been there before. I'm not predicting again if I don't believe in it.
So you don't.
I don't.
So in what ways do you think that this moment is similar or dissimilar to '08?
The difference between then and now is now you have a let's make a worst case scenario. There's a trade war of some undetermined dimension, and it causes a global recession. That to me is the worst case scenario for here. The worst case scenario in '08 was the end of everything. Is a big difference. When let's take an example. If General Motors tomorrow went bankrupt, let's just say hypothetically, what would happen? Everybody who works at General Motors would lose their jobs, and the government did not bail them out. Let's say worst case scenario for GM got liquidated. General Motors goes bankrupt. Its employees lose their jobs. A lot of the companies who supply things to General Motors would have to lay people off. Some of them would go out of business. For that part of the industry, of the economy, that would be very bad. And how much of an impact it would have on the entire economy of the United States, I can't dimension it, but it maybe would cause a recession. Maybe, I don't know. When JP Morgan goes down, planet Earth burns. Hard stop. It's the end. People can't get their money, but nobody trades stocks. Things stop. After '08, I was talking to a friend of mine who ran a small chemical company in New Jersey. And I said to him, like, when it was over, I said, what was '08 like for you? And he said, the first 9 months of '08 were good. And then things stopped. I said, you mean like things slowed down? He said, no, things stopped. Nothing moved. And that's because people were worried about the money that they had in the bank. When you're worried about the money that you have in the bank, things stop. When there's a global trade war, there's a recession. It's a whole other dimension.
Yeah, you're mourning paper losses in this case. And back then, you were worried about getting anything out.
Anything. Right. You were worried that things were going to go to zero.
Now we're just like, oh, well, my portfolio isn't up 20%. It's
I've lost money.
down 10%.
Right.
Yeah. Which sucks.
David Portnoy, for example, was upset over the weekend, I think, that he was down $7 million. He was down $7 million from 100. Nobody likes the come down. But there's a difference between, going from 100 million to 93 million versus going to 100 million and worrying that your 100 million is gone.
Yeah, but I don't even know if Dave's 7 million was some paper gain that he rejoiced and he thought he had. Like, did he actually lose money? Right? The most important days in the market are the days you buy and sell.
Yeah, you look at your portfolio when it's lower and you feel bad. I mean, that's
sure.
That's how we all react.
Yeah, but mourning paper losses, rejoicing paper gains is a tricky business to be in.
Absolutely.
So in '08, the crash was about excessive leverage, systemic risk, hiding in plain sight. What we're seeing now, though,
not hiding in plain sight.
Well, one of the reasons you were able to see what no one else did in '08 is you were looking at these primary sources, right? You were going to Phoenix, you were going to Miami, you were seeing this stuff with your own eyes. You were looking past the headlines, and was Twitter around then? Twitter was around then. You were looking past, presumably, I don't know if you were looking at tweets at the time.
I was not on Twitter.
But the usual talking points. And that's harder to do now, especially when everybody, with a TikTok account can call themselves a financial advisor because they stayed at a Holiday Inn once.
Right.
So where would you tell new retail investors to go to assess an investment opportunity?
Well, the first thing I would say to people is that the statement that I'm looking for an information edge is overrated. And what I mean by that is, people think that in '07 and '08 that I had access to information that other people did not have. And that's just not true. The biggest data source that I had was from Moody's, where the securitizations report every single securitization reports all its credit data every single month. That was the Bible. That piece of information that came out every month during 2 days a month in the middle of the month was more important than anything else because those were hard numbers and they couldn't be faked. And I viewed that data very, very negatively. And it kept reinforcing the other research that I did. But other people who looked at the same data came to conclusions that, well, it's bad, but it'll get better. So information is important. It's the interpretation of the information, I think, that is more important.
So what are you looking at now? Are you still looking at Moody's?
And once I look at the Moody's data, but there isn't a credit issue in the United States at this point. If there's a recession, see, the difference between then and now in terms of credit data was their leverage got so high and so many bad loans were made that the credit data deteriorated before there was a recession, which is unusual. Usually what happens is there's a recession, people get laid off, and then the data gets bad. So, right now, if you were to do a deep dive in the credit data, you would see delinquencies are up some. It's no calamity. It's within the normal bounds. And if you talk to all the banks, they basically say the same thing. Now, if there's a global trade war and then there's a global recession, the data will get bad. But that's almost tautological.
Do you think there's an issue with the housing market?
Not even a little bit in terms of credit. I don't think a subprime mortgage loan has been made in the United States since 2007. Not one. I mean, I may be exaggerating a little bit, but basically, there are no subprime mortgage loans made in the United States. The issue with the housing market is that it's locked. And the reason why it's locked is that during COVID, because rates went to zero, anybody with a pulse refinanced their mortgage at 3%.
And why would they give that up?
Exactly. And so if you're going to buy someone's home today, you're paying 6.5, 7. And one thing I learned in first grade is that 6.5, 7 is a lot more than 3. In fact, it's more than twice as much. And so it's very hard to get, that's why existing home sales are so moribund. And the new homes were doing very well for a while, and the big home builders were giving people incentives. They were buying down people's rates, and that helped a lot. But that seems to have run a lot of its course. So even new home sales are kind of just flattish. The only thing that's going to get the housing market really going again is either time, a lot of time, or rates have to come down. I think mortgage rates have to get to 5. Something like that.
I mean, people think that they're going to get back to 3, though. And I think that it's important
if things get back to 3, that would be very bad for everybody.
Right. Okay, so can you unpack that? Because we had unnaturally low interest rates, right? Back in the 80s, they were 20%. 6 doesn't look that bad. I also learned in first grade that, 20 is a lot more than 6, which is a lot more than 3.
A lot more.
And so, when we had next to nothing, when we had next to zero interest rates, that was because we were facing Armageddon. We were facing the end of the world.
Well, we were facing the world. We all thought we were going to die. So
and we don't want that.
And we don't want to die.
To get a,
for rates to go back to 3, God forbid they should go back to 3. Because if rates go back to 3, we'll have so many other problems. You're not going to be worried about buying a house. You'll be worried about a lot of other things. So,
because these are emergency extraordinary measures.
Exactly. So could they get to 5, 5.5? Yes. Would that help the housing market? Absolutely. Is everybody with a 3% mortgage that owns a home going to sell their home? No.
So an inventory problem.
It's an inventory problem. It will certainly help. How much? We'll see.
Well, we'll have to watch the 10-year, which is, I think looking at how yields are reacting is a really fascinating part of this whole story.
I agree. Near term, people are taking a short-term view that the whole trade policy puts the dollar at risk. I think that's wrong for the reasons that I went into. But that, you can't, short-term trading is short-term trading. It'll work itself out eventually.
So just to clarify, when you say de-risk to our listeners who are nervous, maybe even panicking, de-risk means scooting more over into fixed income, into US Treasuries, right? Or is
Just
there
put your
something
money,
else,
or just
another
put your
move
money into your money market fund and sit and wait. Treasury money market fund, which is paying
for?
foreign change. It's not so bad. Just park it there. You don't have to worry about it. And then when you feel more comfortable, you buy again.
So having the dry powder, are you waiting for a 2,000-point drop?
I'm not waiting for a 2,000-point drop. I don't
Not
think
you.
No, I understand what you're saying. What I am waiting
Generally.
for is resolution.
Certainty.
Some level of certainty about which way this is going to go. Because if it resolves well and you've raised some cash, so you missed the first couple of days. Big deal. If it resolves well, you're back to a bull market that will probably last years. So what difference does it make? On the other hand, if it resolves poorly, you'll be happy to have had some of that cash.
Well, when this has happened before, 87 we mentioned, and 08 and 2020, the next 5 years have gone up 100%.
Correct. But during the interim, it was hell.
Sucks.
It was hell.
It sucks. All right, Steve, we end our episodes by asking all of our guests for one tip that listeners can take straight to the bank.
Straight to the bank?
Straight to the banks that still exist, that are still standing. Straight to Jamie Dimon.
I'll give a career tip, since your audience skews young, and maybe this will be helpful to them. And this is partly from my own personal experience. So if you go back in time, I graduated law school, I clerked for a federal judge, which was great, and I went to work for a big corporate law firm, and I was utterly miserable. So here's my lesson, is that I don't agree with Warren Buffett where he says, pursue your passion. And the reason why I don't agree with it is you could love opera, but if you can't sing, you ain't going to be an opera singer. Pursue your attributes. So when people come to me for career advice, what I say to them is try and figure out what are your attributes. What are you naturally good at? Is it math? Is it science? Is it writing? Whatever it is, the career you choose should be the place where you can do that, as opposed to being a round peg in a square hole.
Money Rehab is a production of Money News Network. I'm your host, Nicole Lappin. Money Rehab's executive producer is Morgan Lavoie. Our researcher is Emily Holmes. Do you need some money rehab? And let's be honest, we all do. So email us your money questions, moneyrehab@moneynewsnetwork.com, to potentially have your questions answered on the show, or even have a one-on-one intervention with me. And follow us on Instagram @moneynews and TikTok @moneynewsnetwork for exclusive video content. And lastly, thank you. No, seriously, thank you. Thank you for listening and for investing in yourself, which is the most important investment you can make.